Hey everyone, this is Kevin Romines with Geneva Financial. Going to talk to you. Hey, where am I at? Oh, wait, I'm in my back 40. Got the trees back there. Going to turn it a little bit. Okay, here's the back side of my house, front side of the neighbor's house, and the back side of the barn for the other neighbor. Why am I coming to you from my back 40? Well, today we're going to talk about USDA loans, rural development loans. They're designed for rural properties, and they're a great loan for you to consider when you're going to buy a house. So let's head into the office and get this unpacked. All right, see you in there. Okay, I made it back to the office, and so let's walk through a few details on the USDA loan. I've got a few slides here that we could take a look at and go through the details. So first up, 100% financing. That's the beauty of USDA loans. There's very few overall programs out there that are available for 100% financing. The programs that are VA, so you must be active duty or a vet. USDA that does have some geographic restrictions because it's only designed for rural areas, so you can't do it in larger cities. And then there is Washington State Bond. Washington State Bond doesn't have any geographic restrictions on where you can do it, so you just get some differences from one loan to the next. The next item is low interest rates, lower than conventional loans. So it is lower than conventional loans. It's a loan that's backed by the U.S. government. Because it's backed by the U.S. government, they can actually give you slightly better rates than you would find on Fannie Mae, Freddie Mac. So that's a huge advantage for USDA. Take advantage of it if you can. Low mortgage insurance, 1% upfront, which is rolled into the loan, and 0.35% adds to your monthly payment. Now, how does that compare? So like compared to an FHA loan, FHA has 1.75 upfront that is rolled into the loan. They just add that to the loan amount. In this case, only 1% is rolled into the loan. So it's a little bit better by 3/4 of a point than FHA. And then on the monthly, FHA is 0.85%, whereas USDA is only 0.35. So it's a 0.5% more. And that can make a big difference on your monthly payment. So those are some advantages for USDA. Next would be requires a 620, 640 minimum credit score. Actually, the reality of that is USDA can be done down to a 580 credit score. But it's really just a matter of what lenders will allow what scores. Our company, we could do it down to a 620. A lot of companies hold you tight at 640 on the credit score. So if you at least have a 640 or better credit score, then you can most likely get approved for the USDA loan virtually at any lender. So talk with your loan officer and make sure of what that looks like. It's available in rural areas only. So it's not available. I believe the population count cannot be over 10,000 in a given area. So if you're in a city that's over 10,000, it's not going to be good for you. However, just maybe 5 minutes outside that city, you could be in an eligible area. There is a USDA lookup tool to determine whether or not the property is eligible. I'm going to walk through that lookup tool in just a second. So hang tight and we'll flip that page. Okay, so I wanted to show you the USDA Eligibility Map. This is where you can go to find out whether or not a given property is eligible for USDA. So just type in here. Okay, so you're going to type in the eligibility map, and then you're just going to click on this link, and that'll take you to this website. And then you're going to say accept. Now you're going to put in your address. So In this case, I'll just use my address, 134-9 Fisher Road, Winlock, and it's going to say that my property is eligible. The reason it says my property is eligible, I'm cheating a little bit. I know that virtually all of Lewis County is eligible. Not virtually, all of it is. But let's take a look. Let's just kind of zoom out on the map. Ooh, a little bit too much. Stop. Okay. So let's go to long view. So one of the things I want to kind of show you, let's pull it up into the middle here. Let's just kind of zoom in just a little bit. If you see the kind of the beige or orange around a given area, that's the area that's not eligible. Anything outside that area is eligible. So if you look at a state map like this, I mean, you're going to get down into Clark County, you're going to get down into Portland, Oregon, and that kind of thing. And then you're going to have some areas that are uneligible. Here's my property in Winlock. It's eligible. You get up here to Olympia and Tacoma and that kind of thing, and clear into King County and Seattle. Most of the state is going to be eligible. If you look at, especially in Eastern Washington, there's not a lot of huge population centers. I mean, you're going to get one here in Yakima and the Tri-Cities. I think probably in Walla Walla, maybe. I'm not sure. Anyway, you can look around the state and kind of just see the vast majority of the state is not in those areas colored orange. And because they're not in the areas colored orange, they're eligible for USDA. Anything in those areas is not eligible. You can come in here and put in a specific address, or you could just do like I did and look throughout the state. In the end, you want to put in a specific address because you might be right on the edge of being eligible or not eligible. So that's one of the tools that you can use to determine whether or not you're eligible. The other tool that you're going to want to use is what's called the income limits. So let's go to that screen. Okay, you're going to come in here and you're going to say, please pick a state. In my state, it's Washington State. And then I need to pick the county. I'm going to say my own county, which is Lewis County. And then it's going to ask you a few questions. How many people in your family? I'm doing a loan for a couple. They're getting ready to have a baby. By the time the baby's born, the loan will not have been closed by then. So they're going to be a 3-person family. So we're going to do 3-person. And then the number of people under 18 at that point is going to be 1. I'm just going to throw some generic numbers in here. These are not numbers that pertain to anybody. So I've already loaded up some of these numbers. So I put in $4,800 a year in annual child care expenses. Let's put $2,950 in for the borrower's income. Let's put $4,500 for the other person's income. And I'm going to go down here and say finish. And it's going to tell me that the total income I have is $89,400. The total deductions I'm allowed is $5,280. That brings my income down to $84,180. And the limit for 502 guaranteed loans, which is the type of loan that we're talking about here, we're not a direct lender, we are a guaranteed lender, is $90,000. So that's the low end. Let's go back. Let's do it as if we're in King County, because King County would be the highest limit that we're going to have in Washington State, most populous area that we're going to have in Washington State. Okay, so we're in Washington, and let's say that we're in King County. And we're going to do the same 3-person household with 1 under 18. We're going to do the same numbers, $4,800 in child care expenses, $2,950 on first borrower's income, $4,500 on the next borrower's income. We're not going to fill out any of the rest of this. Just make it nice and easy. Base pay is the quickest way to go. And it's going to tell me the same numbers. 89.4 is what my income is, minus the deduction of 5,280 means my income, household income, is 84,120. I'm allowed 140,650. So The low end, low populous areas in terms of the counties, it's going to be about 90,000 is your income limit. The upper end for the counties, it's going to be 140,650. So that'll give you a good idea. But double check your county, make sure of what your income limits are in your county, and compare that to what your income is. If it's something that's a bit confusing for you, just have your loan officer go ahead and do it for you. But I hope you found these tools to help you. So I hope you found that map and that tool good, something that you can look up and do for yourself. It's pretty easy. It's not really complicated, and it's good to look up, is the property eligible? Am I eligible based on my income? So I'm glad that we segued to that other part. And now we're on to this one, income limits. The income limits are, generally speaking, for Washington State, from 90,000 on the low end to 140,000 on the high end. So I'm in Lewis County. Lewis County is a standard county. There's no high income limits in this county, so we're at $90,000 maximum income limit. If you were to be in the Seattle area, King County area, anywhere in that county, then your income limit can be as high as $140,000. And I believe that I had taken you just previously to the income lookup tool. So you spend some time, do that, and make sure you're eligible. Or better yet, don't worry about it. Let your loan officer determine whether or not you're eligible, and your loan officer can guide you. Next is flexible credit guidelines, underwriting guidelines. USDA can be a bit more flexible than your Fannie Mae, Freddie Mac, and maybe even so FHA loans as well. So get with your loan officer, walk through the details of your specific credit, and see what can be done based on the flexible guidelines. Okay, USDA can be used on existing manufactured homes 2006 or newer. So the one caveat I want to give you on that, Washington State is part of a pilot program. Where most states are not in this pilot program, we happen to be in a pilot program. In this pilot program, it allows you to buy an existing manufactured home that was built January 1st, 2006 or later. That's a new twist. It used to be that USDA, without this pilot program, would only lend on brand new placements on manufactured homes. And so the states that are not in the pilot program, that's what they're stuck to. Only loans on brand new placements. Washington State, among other states, is one of the pilot program runners. And so because of that, we're able to use this pilot program, and you can buy a manufactured home, an existing manufactured home on land, and so long as it's built after January 1st, 2006. That's a huge advantage. Take advantage if you can. No cash reserves required. So USDA in certain circumstances may require cash reserves. What is cash reserves? Well, let's say that your monthly payment was $1,500 a month. So to have 1 month in reserve, you must have an additional $1,500 in the bank after you close the loan that doesn't get used or spent. Now, once you close the loan, whatever you use that money for, that's up to you. But through the point of closing the loan, you have an extra $1,500 a month, or $1,500 in your bank account. That equates to 1 month reserve. The most USDA is going to want you to have would be 2 months reserve. So in that case, you would have to have an extra $3,000 over and above what it costs you to close the loan, and you would keep that in your bank account to the point or through the point where you have funded the loan. From that point forward, what you do with the money, that's totally up to you. Nobody cares. Ability to finance repairs and closing costs into the loan if the appraisal comes in high enough. The caveat is if the appraisal comes in high enough. So let's just use an example. Let's say that you were buying a house for $300,000 and the appraisal came in at $315,000. Well, you would think, okay, I'm buying the house for $300,000 at 100% financing. My loan would be $300,000 as well. But don't forget, we talked about the upfront mortgage insurance, and there's a 1% upfront fee. So they're going to roll that into your loan. So instead of a $300,000 loan, you're going to have a $303,000 loan. So the difference between the 303 and the 315, that's money you can use to cover your closing costs. So that would be $12,000. I would highly doubt that you're going to have anywhere close to $12,000 in closing costs, but you would just raise your loan amount by the amount that you need in order to cover the closing costs as well. And that's a great way to save money, not to have to come out of pocket for that kind of thing. So if you can use that, if the appraisal comes in high enough, that's a great tool to use, and that's unique to this loan. You cannot do that on any other kind of loan. Okay, home improvement loans and grants up to $27,500 and may not need to be repaid. So this is just a unique program to USDA. It is not tied to a purchase. It's not tied to a refinance. It's its own separate loan. So if you had a home and you were a lower income borrower and you qualified in the lower income brackets, or you were 62 years old or older, and you had home improvement needs, but you don't have any money for it, you can't afford it. Well, where do you get the money? USDA has a great program. They'll loan you up to $20,000 as a loan. 1% is the interest rate, so a very low monthly payment. And they will also potentially give you a grant. The grant is for 62 and older, and it doesn't necessarily need to be paid back. So if you are 62 and older and you have need for $27,500 worth of repairs, you can get that through the combination of the loan at 1% up to $20,000 and then also the $7,500 grant. The other thing that's unique, and I don't know the details about this, Washington State is considered a higher cost state. Because we're a higher cost state, you can actually get a little bit more than $20,000. But I don't know how much that actually is. But it's another great, unique loan and grant that you can get through USDA that you're just not going to find anywhere else. So if you need it and if you can qualify for it, let's get you in and get you that loan and that grant. Higher debt ratios allowed if you have a 680 or better credit score. Okay, so the debt ratios, the standard debt ratios on USDA is two debt ratios. It's a housing ratio and a total ratio. So the housing ratio, what that refers to, is a maximum of 29%. What that means is, let's say just for round numbers, you made $10,000 a month. That means 29% or $2,900, your housing payment cannot exceed $2,900 or 29% of your gross income. So that's the housing ratio. Your loan officer can help you determine whether or not you're within guidelines on that. And if you're a little bit over, then you're just going to have to lower your loan amount just a little bit to get within those guidelines. The other debt ratio, 41%, is your total debt ratio. That is your house and all of your consumer debt as a dollar amount compared to your gross income. So again, back to $10,000, you cannot spend any more than $4,100 a month in total debts because that would put you at 41% on the debt ratio. Can you exceed the 41%? And the answer is yes, you can exceed it, but you must have at least a 680 credit score, and you might want to have a couple other factors like maybe some cash reserves and that kind of thing. The stronger your file is, the more likely you're able to exceed that original 41% debt ratio. How high can you go? You can go up to about 46%. So that's comparable, that's getting close, that's comparable to Fannie Mae, Freddie Mac conventional loans. It's not anywhere close to what you would get on FHA loans. So there's pluses and minuses with every loan. USDA is just a little bit tighter on the debt ratio, and so long as you can make that work, then that's great. All right, so that is our final slide, and let's take it back out. Let's get outside while there's at least some sunshine out there. Okay, so I hope you found that informative and a very useful tool, and it gets you really thinking about the USDA loans. Is it one of the loans that you might want to use when you're buying your house? If you have a USDA loan and interest rates are much lower than where they were when you bought it, you might want to refinance. But I hope you found this useful. If you have any questions, I'd love to answer any questions. You can always reach out to me in one way or another. Get me on Facebook, call me, text me, email me. one way or another, we'll connect up and let's get your questions answered and get you that much closer to home ownership. All right. Enjoy the rest of your day. I've got a little bit of sunshine. I'm going to do it. All right. See ya.